Alright, welcome back to another little video. This is End here from bullwaves.org. I'm going to talk about the bond market today. This is the 10-year Treasury, US Treasury. I think we may have seen a pretty significant high this week. The move off the high has been very interesting. I've been tracking this wave 2 high for a while now, and the account has developed obviously as the market has kind of continued to retrace higher, but you have an altered count here. Well, first of all, I'm tracking a wave 1 and 2 and a lower 3 1 2 pattern, which suggests a decline into a large third wave. You could also count this as a 1 2 3, a triangle wave 4, and a little blip lower in wave 5 as the large degree wave 1. But either way, both suggest a move down into a third wave over the coming months. So the problem at hand is how to view this recent decline here. So that's the daily chart. Let's get down into the 4-hour chart. You can see here, depending on where you strike wave B, it could be a kind of a failed C wave as a part of a flat or a combination. It could be a straightforward three-wave move down in wave B here. Both of those interpretations would suggest an ending C wave either way. So I've been kind of working with this low here as wave B and moving higher into a C wave. So I had been initially looking for a correction in wave 4, and that correction has extended this week. So I kind of changed tack this week with the idea that maybe this market is topping out for once and for all. You can see that the price actually touched the previous wave A high. So initial support there at the previous wave A high did cause a little blip higher on Friday. But let's get into the short-term count here, and I'll show you what I think that could be part of. So here's the hourly. And you can see that's the previous high there late last week. And I can count 5 waves down. Wave 1 down, a 3-wave correction in wave 2, an extended wave 3 down, a 3-wave correction in wave 4, and a little pop lower to complete wave 5. So 5 waves down. And on Friday we saw a spike off the low, which could be the beginning of wave A. So from here we'll be looking for 3 waves up in wave A to complete an impulse pattern, a bearish impulse pattern to the downside, and then we'll be able to work to kind of identify at that point we'll be able to identify some pretty decent confirmation levels for the larger pattern. But so far it is starting to tilt very much in favor of the bearish outlook for bonds. And if that's the case, you better believe that the corporate bond market would be in a very precarious position, given the size of it and given the way that much of the base levels that the corporate bond market is priced at is based on the long-term US Treasury rates. So if Treasury yields start spiking on the long end, and we got a huge amount of corporate debt to roll over this year at higher rates, so that's gonna really squeeze corporate America, corporate world really, you should probably say. But anyway, that's what I'm looking at in the Treasury market. If you want to get nightly updates on this and many more markets, check out bullwaves.org. Check out the membership prices there, and we'll see you in the nightly updates. Thanks so much. Bye bye.